Welcome, everyone. So today, we're going to dive into the core principles of accounting for decision-making. Now, I know what some of you might be thinking, that accounting is just about bookkeeping or, a bunch of tedious calculations. I really want to challenge that idea right from the start. I want you to start thinking about accounting not as a math class, but as the true language of business. It's the universal way that a company communicates its performance, its health, and its strategy. Seriously, mastering this language isn't just about passing a course. It's about giving you the tools to be an effective leader, someone who can read, interpret, and ultimately write the financial story of any business you're a part of.
So, let's kick things off with a really critical question, one that trips up so many new managers and even some seasoned executives. Look at the screen. Is a company with a ton of cash in the bank automatically a profitable company? Now, your gut reaction might be, well, yeah, of course, cash feels like success, right? But in the world of accounting, the answer is a hard no. And understanding the difference between cash on hand and actual profitability is probably the single most important lesson you'll learn in managerial accounting. It's the difference between looking at a snapshot of what's in a company's wallet versus understanding the long-term health of its entire economic engine. We're going to unpack exactly why that is today.
All right, here's our game plan for today. We're going to start with the big idea, the language of business, just to make sure we're all on the same page about what accounting is for. Then we're going to get into the two main pieces of the puzzle, recognizing your revenue and understanding your expenses. These are the absolute building blocks. And finally, we'll put it all together to understand what everyone wants to know about, the bottom line, profit. The whole idea here is to move step by step from the theory to how this stuff actually works in the real world.
Okay, let's jump into our first section, the language of business. And that subtitle, Moving Beyond the Numbers, is really important. This is where we need to shift our whole perspective. For you, as the next generation of business leaders, you have to see things like an income statement or a balance sheet not just as a page full of figures, but as a story, a narrative. These documents tell you about a company's wins, its losses, its challenges, how efficient it is, everything. Your job isn't just to read the numbers, it's to interpret the story that they're telling.
This quote right here, it perfectly sums up the whole point of accounting principles like GAAP, that's generally accepted accounting principles. You should think of GAAP as the official rule book, the grammar and the syntax for this language of business. And why do we need it? Well, imagine if every company just made up its own rules for telling its story. It would be chaos. You couldn't compare anyone. By having this standardized framework, we make sure that a statement of profit means the same thing for a startup in Silicon Valley as it does for a manufacturer in Germany. That consistency is everything. It's the foundation of investor confidence and smart management.
So, if accounting tells a story, let's get to the first major plot point, revenue. This brings us to section 2, recognizing your revenue. And the question here, when have you actually made money? Sounds almost too simple, right? But I promise you, getting the timing of revenue recognition right is one of the most critical and, frankly, most misunderstood concepts in business. Getting this wrong can lead to some truly disastrous decisions.
Okay, this slide introduces what might just be the most important rule in all of financial accounting, the revenue recognition principle. And it's simple. Revenue is recognized when it's earned, meaning when the service is done or the product is delivered. This is the heart and soul of what we call accrual basis accounting. Now, the alternative is cash basis, where you'd only record revenue when the money actually hits your bank account. But for any company of real size, the accrual basis is the only way to go. Why? Because it gives you a much truer picture of your company's actual performance in a given period. It measures the value you've created, not just the cash you happen to collect.
Let's walk through an example to make this crystal clear. So look at step 1. Let's say your company performs a service for a client in December. The work is finished, value has been delivered. That means, as you see in step 2, you must recognize that revenue on your December financial statements. This is the key moment. Now, look at step 3. The client doesn't get around to paying you until January. If you were doing cash basis accounting, you'd record the money in January. But under accrual accounting, which is what we use, it doesn't matter when the cash shows up. The economic event, the thing that generated the value, happened in December. So the financial story has to reflect that.
So this all leads to a really important question for you as a manager. In which month was the business actually more successful? Think about it. Was it January, when the money landed in your account? Or was it December, when your team did the work? Based on the rules we just talked about, the answer is, without a doubt, December. December is when your people put in the effort, when you used your resources, when you actually created the value for your client. The financial statements for December have to show that success. The thing that happened in January? That's just settling a bill. It's a financing event, not an operating one.
And this brings us to one of the most common and dangerous mistakes I see students and even professionals make all the time. You have to burn this into your brain. Revenue is not cash flow. Let's play this out. Imagine you're a manager. Your head of sales runs into your office just ecstatic. She says, "Boss, you're not going to believe it. That huge invoice from the Acme project last quarter, they just paid. We've got $1 million in the bank. The team crushed it. Let's get those sales bonuses approved." Now, the untrained manager, the one who thinks cash equals success, says, "That's incredible. Let's cut the checks." But you, because you understand the revenue recognition principle, you hold up a hand and say, "Hang on, that's fantastic news for our bank account, but that $1 million is for work we did and we recognized as revenue last quarter. It tells us nothing about how we performed this quarter. Before we even talk about bonuses, show me the revenue we earned this month." See the difference? Making decisions based on when cash arrives can mask huge problems. You could be celebrating a big payment while your actual sales have fallen off a cliff.
All right, so we've spent a lot of time on the top line of the income statement, or revenue. Now in Section 3, we need to look at the other side of the coin, understanding your expenses. It's a simple truth of business, right? You have to spend money to make money. And these costs of doing business, are every bit as important as revenue when it comes to telling the company's story. Honestly, how a company manages its costs is very often the difference between winning and losing.
Now, what's really important to get from this slide is that not all expenses are the same. On the left, we have operational expenses. Look at the examples: salaries, rent, utilities. These are the costs that come from the main day-to-day job of running the business. On the right, non-operational expenses, like interest you pay on a loan. See, that's not a cost of making your product. It's a cost of how you decided to finance your company. So why is this split so important for a manager? Because it lets you see how efficient your core business is, separate from your financing or investment choices. It helps you answer that fundamental question: is our actual business model working?
Okay, so we have now assembled all the key pieces of our story. We know how to properly account for the value we've generated, that's our revenue, and we know how to categorize the resources we've used up, those are our expenses. Now, in our final section, we get to bring it all together. This is the moment of truth. This is where we calculate the bottom line profit, which is the ultimate measure of how a company performed over a period of time.
So the calculation starts right here, with our total revenue. This is the number we got by using that revenue recognition principle we hammered on earlier. It's the total value of all the services we performed or all the goods we delivered within a specific time frame, like, say, the month of December. Next up, from that revenue, we subtract our total expenses, but, and this is so important, it's not just any expenses. Here, we apply another huge concept, the matching principle. This rule says we have to record expenses in the very same period as the revenue they helped create. So for example, if you pay a salesperson a commission in December for a sale they also made in December, you match that commission expense to that sales revenue right there in the same month. This gives the truest picture of profitability. You can't just recognize revenue in December and then push the costs into January to make December look better. That's a huge no-no. You have to match them.
And the result of that simple subtraction is net profit. You'll also hear it called net income, or most of the time, simply the bottom line. This one number is basically the final score on the company's report card for that period. For an investor, it shows the return they're getting. For a manager, it proves whether the strategy is working. For an employee, it's a sign of job security. It answers that one big question: did we create more value than we consume? So, let's say a company makes a profit. Great. What happens to that money? It doesn't just sit in some vault. As you can see here, management has a really important strategic choice to make. They have two main options. First, they can reinvest it right back into the business. We call this retained earnings. They can use that cash to develop new products, open new stores, upgrade their technology, basically to fuel future growth. The second choice is to distribute that profit to the owners, the shareholders, as a cash payment, which we call a dividend. And let me tell you, the debate over whether to reinvest for growth or pay out dividends is one of the biggest strategic questions in all of corporate finance.
So as we wrap this up, I really want you to see this whole process in your mind. From correctly recognizing revenue, to matching your expenses, to calculating that final profit, understanding this entire flow is what turns you from just an administrator into a real strategic leader. This is your toolkit. It lets you go beyond just a gut feeling and start answering the most important business questions with real data. Are we running this place efficiently? Is our pricing right? Are we actually growing in a healthy, sustainable way? The answers aren't just hiding in the numbers, they're in the story that those numbers tell. And so I want to leave you with one final thought, a scenario to chew on. Imagine this. Your income statement shows a nice, healthy profit.
On paper, you're a success. But then your finance chief tells you that you don't have enough cash to make payroll next week. This situation, being profitable but broke, isn't some weird academic puzzle. It is a terrifyingly common reality for so many businesses, especially ones that are growing fast. It's the ultimate test of whether a manager truly gets the concepts we've talked about today. Your next decision could literally mean the company survives or fails. So what do? How do you collect your receivables faster? How do you negotiate with your suppliers? This is the moment when the language of accounting becomes the language of survival. And that is the kind of critical thinking this knowledge prepares you for.